Hello guys, welcome back to Nairobi Legal Insights. My name is Kelly Nyaga and today we'll be looking at the income tax. Specifically, we'll be calculating the payable income tax. Welcome. Now, the first step of determining the payable tax is establishing the taxable income. Now, these two terms are separate. The payable tax is the amount of tax you pay, and the taxable income is the amount of your income that can be taxed. Now, in determining the taxable income, there's a four-step formula. The first step is adding back the non-deductible expenses to the gross income. The second step is subtracting the deductible expenses from the gross income. The third step is adding back the depreciation that the accountant had subtracted. And the fourth step is subtracting the depreciation in line with the Income Tax Act. Now note that the depreciation in these two cases is different. This is because the depreciation counted by the accountant may not necessarily align with the depreciation that is set in the Income Tax Act and is subtracted by KRA. Now in this particular video, we will be discussing the non-deductible expenses and the deductible expenses. Stay tuned to see the explanation on the differentiation of the depreciation in the accountant's perspective and the depreciation in KRA's perspective. Additionally, while this formula may look straightforward, it can get a bit complex, and we will guide you by providing you with a sample question in our next video. So, deriving from the basic formula of calculating the payable tax, we will first go to the first step. This is a gross income. Now, this is the income that you have before the taxman takes his cut. The second step refers to the deductible expenses and non-deductible expenses. Here, the general rule is this. The expenses incurred in line with generating income are deductible expenses. However, if expenses are incurred and they are not in line with generating this income and the operation of the business, then they are non-deductible expenses. Now, for an elaborative list of the deductible expenses, refer to section 15 of the Income Tax Act. For an elaborative list of the non-deductible expenses, refer to section 16 of the Income Tax Act. Now, to provide an example to make it easier to understand, if a CEO is provided with money to buy airtime to make calls, then this is a deductible expenses because that airtime is in line with the generation of the income where he's making business calls. However, if the CEO is provided with a vacation by the business, this is not a deductible expense because it does not align with the generation of income of the business. Unfortunately for this CEO, it falls under non-deductible expenses. Finally, remember to subscribe to Nairobi Legal Insights for more legal insights on the taxation law in Kenya. There will also be another video that will further elaborate this basic formula. Thank you.